So I think we will slowly start. Does it work? The technical aspects work? Yes, it does. We will have a little bit of a drop-in while we are slowly starting, but I think that's okay, since we in Sweden, I was telling Sean, are obsessed with punctuality, so I don't dare to wait too long to start the seminar. Very welcome everybody to this seminar on the banking union, what's in it for Sweden. My name is Karolina Ekholm. I'm the head of the EC Commission here in Sweden, and our ambition is to do exciting seminars on topical EU policy issues, and I believe we have succeeded this time because it's difficult to see any more topical issue right now, given the decision by Nordea to move yesterday. And also we have a couple of very interesting proposals that the European Commission has tabled this week on the banking union, on the NPLs, the non-performing loans, but also on the capital market union, which I suspect Sean will go into. We're also very happy to do this seminar together with SNS, the think tank, and the House of Finance at the Stockholm School of Economics, so it's a joint event. We have two very distinguished speakers, John Berrigan, who is the Deputy Director General for DG FISMA, and that's the Directorate General within the European Commission in Brussels, which deals with financial stability, financial services, and capital markets union. And then we have also Karolina Ekholm, who is sitting here, who is State Secretary in the Ministry of Finance. And we're very happy that we have Pehr, who is Senior Advisor at the Swedish House of Finance at the Stockholm School of Economics, and who will take us through the discussions and moderate. So Pehr, the floor is yours. Welcome.
Thank you very much, Katarina. It's very nice to be here. You introduced the discussant, so I can skip that. We will do it like this for the first 30 minutes or so. John Berrigan has a word to describe, well, basically answer the question, the banking union, what's in it for Sweden. And then Karolina Ekholm has promised to give her comments on that for some 15 minutes. And if we succeed with that, then we will have 30 minutes for comments, discussions, whatever. So please raise your hand and wait for a microphone. This is being filmed, so you need a microphone so the sound gets recorded. And we will take the questions, and we will have 30 minutes for that. So that's a very simple layout of this morning. Once again, very much welcome, and especially welcome, Sean. Floor is yours.
Thank you, Katarina. Thank you, Pehr, and thank you to the hosts. So I think there's 3 hosts: SNS, Swedish House of Finance, and my own permanent rep. So thank you to those for hosting. I have an impressive attendance, I'm told. So yes, it's quite full. So I have to not disappoint people, but I'm not going to sing. So be aware of that. The topic I have, though, is an interesting one. It's to describe to you the state of play in banking union, and then I have to tell you what's in it for Sweden. So there's no pressure on me there either. But I am very happy to be here in Stockholm. I have been here once or twice before, always in this time of the year, always at this temperature for some reason, but okay. But we had a sort of Soviet, not Siberian, I should say, blast. We've had a Soviet blast as well, but we had a Siberian blast in Brussels, so I'm kind of acclimatized, so it's not too bad. I was just thinking coming in here, one of the good reasons why Sweden might want to join the banking union is I'm pretty sure the average temperature is higher in the banking union than here, so that's good. I want to kind of frame my remarks in 4 sections. So one is to say why we have banking union, so do a little bit of history just to explain to you why we went to the trouble of doing this. Then maybe say what banking union is, so what it looks like today, where we are with it and where we're going to go with it. And then I'll finish by addressing, I suppose, the question you want to hear me say is, why should Sweden join it now? Now, I could make a very aggressive sales pitch here. I think Karolina probably knows I can make an aggressive sales pitch when I want. But, you know, I know Swedes are sober, sensible people, so I'm not going to do that. I'm going to make something what I think is a realistic assessment of where we are. and what will be the prospects for Sweden inside the banking union. I have about 9 slides, nothing fancy, just slides. In fact, to be honest with you, I'm Irish, so I'm not obsessed with punctuality, so this is to stop me wandering off and talking for half an hour, so they're more for me than they're for you, but I don't know, can I press the red button, I guess? This one? Okay, very good. So let me kind of show you my notes, basically. So I wanted to start with a bit of history, as I said. Why did we go to the bother of having a banking union? We went to the bother of having a banking union because the economic and monetary union was not prepared for the impact of the global financial crisis. I spent a lot of my early part of the crisis defending the euro for not having caused the crisis. I do not accept that the euro was the cause of the crisis. It's certainly not the financial crisis. You know, countries like the United States, the United Kingdom, all of these unitary states outside the monetary union all had crises. Iceland had the mother of all crises. They were not members of the euro area. Countries within the euro area like Finland or Austria or France didn't have much of a crisis either. So there was no one-to-one link between being a member of the euro and having a financial crisis. But what the euro did do was to make the management of financial crisis within the union more complicated because it wasn't finished. And essentially what had happened, I think, was that in the monetary union, cross-border banking had taken off after we launched the single currency. So if you look at the figures, from 1999 was the big trigger for cross-border banking in Europe. And this cross-border banking integration took place, I think, on a kind of false premise. It took place on the basis of a premise that if Europe got into trouble as Europe, then Europe would respond as Europe. So there would be a centralized crisis management, and that centralized crisis management would involve lots of public money. I think when the crisis hit, and it was very clear to the markets that in fact this was not going to be the case, it was going to be a decentralized response, with public money of course, home bias re-emerged. Home bias being the bias in the financial system to repatriate to its own home. So you saw these cross-border banks immediately begin to unwind, and all their Spanish liabilities moved to where their Spanish assets were, all their Irish assets moved back to where the Irish liabilities were, etc. So we had a sort of renationalization of the financial system. When that happened, then you had what was called the creation of a bank sovereign nexus. The interactions between local banks and local sovereigns became quite toxic. The local banks depended on their local sovereigns to bail them out, and their local sovereigns were extremely dependent on their local banks to finance them. And this created sort of what were called doom loops. So as in the case of Ireland, the banking system got into trouble, the sovereign very quickly followed. Or as in the case of Greece, if the sovereign got into trouble, the banking system quickly followed. We took measures to kind of address this. So we had the ESM first, so we had the European Stability Mechanism, preceded by something else I won't go into. But this was designed as a kind of managed crisis in countries, a sort of IMF for Europe. And then we had the ECB, which began to take measures also to underpin the euro. But these were seen as sort of temporary crisis responses. And what we needed was something more fundamental, something more long-term, that would do two things. Ultimately would re-establish the basis for a cross-border banking model in Europe, but in doing that would also break this, and to do that, would break this link between national sovereigns and their banks. And I'll point out later, it's not just to break the link in terms of the financing, it's to break the link at all levels in terms of this national sovereign, national bank link, because it's not entirely healthy at various levels, and I'll come back to that later. What did the financial crisis reveal about the EMU in terms of its weaknesses? Well, we had no crisis management framework. The EMU was not built to manage a crisis. And when the crisis hit, we had to start inventing things on the spot. One of the tools we invented, the European Financial Stabilization Fund, was actually created over a weekend. As you might imagine, we then had to spend the next year improving it, but it was created over a weekend. I'll give you an example of what we had to do when the crisis hit. We found there were gaps in the regulatory framework. This was not unique to the monetary union, But these gaps in the regulatory framework were a big problem for the monetary union because it meant that these weaknesses were interacting with the other parts of monetary union which were not built for crisis. So we had to address these gaps. We had inadequacies in national supervision, and this is the point I wanted to make earlier, that in many cases the crisis is in large part put down to regulatory failures. But to be honest, the financial crisis was 50% a regulatory failure and 50% a failure to implement the rules that were already there. So it was also a supervisory failure. We had an absence of credible resolution options. What I mean there is that we had no way to handle failing banks except to pump public money into them. This was all we had. And this is perhaps okay when you have one bank. But when your entire banking system is in trouble, the amounts of public money involved, the amounts of public money that has to be either given or pledged to the banking system become very large. And this became a problem not just of economics, but some people would argue it became a problem almost of democracy at one point, when the amounts of money which were being needed to support the banking system became known. And this taxpayer exposure to bank failures was one of the main driving forces of a kind of banking union response to the financial crisis. Now, what did we do in terms of banking union? It was in essence a response to these EMU weaknesses. They're not the only weaknesses in EMU, but these are the financial side weaknesses. We decided to set up an institutional framework which would better prevent and manage crisis. We thought that we would build on the reform of the EU financial regulatory framework, which itself was part of a global effort. But by building on that reform, I mean to implement it in a way that was more convergent. A lot of the regulatory framework in the EU is built not on direct regulation, but on what are called directives. And these directives allow member states a considerable amount of discretion in how they apply them. Within the banking union, the intention is to essentially replace that discretion, use a single supervisor to implement these rules on a more consistent basis. So we want to centralize supervision, which we did, and enhance the quality of supervision, which I think we did also. We wanted to centralize and enhance resolution. When I say enhance it, in most cases it was to actually create it. In most countries there was no resolution function. If banks were failing, the public sector gave them money, and that was that. We wanted to set up a regime which allowed an alternative to the public sector, being the automatic bailout mechanism. And that involves setting up a resolution framework, and also involved a very important concept whereby instead of using public money, we could bail in private stakeholders, in particular bondholders, to finance bank failures or bank problems. And so in all these ways, we wanted to essentially maximize the protection for taxpayers from bank failures. And on this basis, we believe we can rebuild the cross-border banking model we had before, which we think is important to underpin growth in the economy. But we will rebuild that cross-border banking model, this time not on the basis of an expected bailout, but on the basis of a resolution with a bail-in. So we think we can rebuild it, but on a much healthier and more stable foundation than was there before. This is the kind of stock chart I carry around with me when I talk about banking union. These are the three pillars and the foundation. So the foundation is a single rule book which applies to the EU 28. It has three main elements, this single rule book. One is the capital requirements, regulation and directive, which takes care of capitalization of banks, many other things as well, but in principle the capitalization of banks. The Bank Recovery and Resolution Directive, this is a resolution framework. These are the rules which allow you now to intervene in the bank that is failing or likely to fail, and to resolve that bank if necessary, and to bail in resolving it again if needed. And then the last one is the Deposit Guarantee Scheme Directive. And this is of course a directive which covers the deposit guarantee schemes across member states. So these rules are all in place. As I said, they are in most cases directives except for the regulation on capital, and therefore member states have a degree of flexibility in how they implement them. But within this single supervisory mechanism, so within the banking union, the intention is to apply all of these rules in a more consistent, in kind of non-divergent way. So on this foundation of rules, you have three pillars. You have the supervisory pillar, which is the single supervisory mechanism. This applies automatically to all euro area members. So if you're a euro area member, you get a free gift, which is a membership of the banking union. So it's 19 countries in there already. This is centered in the ECB. So it's located in Frankfurt. It's part of the European Central Bank. It has an interesting governance in the sense it has a single supervisory board which is made up of the 19 supervisors of the member states plus a group appointed at the center, chaired by Daniel Nouy, formerly from France. The decision-making body, however, is the Governing Council of the ECB, which I think is going to be an issue when I come to talk about Sweden. Sweden does not sit on the Governing Council of the ECB. But what I will say here is that the Governing Council, the decision-making arrangements are such that the single supervisory mechanism do not find a lot of tension between what they decide and what the Governing Council decides. But because of the specific structure of the ECB, the only decision-making body of the ECB can be the Governing Council. So formally, the Governing Council must make the decision. A rather interesting similarity comes in the single resolution mechanism. Again, this is an automatic membership for euro area countries. So there are 19 members. We have a single resolution board, which is 6 people who sit at the center, so a somewhat different governance mechanism to the supervisor. So this is not part of the ECB. This stands alone with the 19 members in a plenary session. However, again, there's a wrinkle here, because under EU law, it was not possible to create the single resolution mechanism as a separate agency, a separate body. And I'm not going to go into this particular complication, but it does mean that formally for them to make decisions, the European Commission has to, in a sense, play the same role as the Governing Council and formally adopt these decisions. This is a problem of the treaty, and whenever we get around to treaty change, there will be an interesting discussion about how we're going to improve this decision-making mechanisms. But I think essentially what you need to understand is that even though they have specific decision-making structures, it's the supervisors who make decisions on supervision. It's the resolution authorities who make decisions on resolution, and not the Commission and not the Governing Council. Third pillar, resolution. This is the funding pillar. This is the pillar that gets most controversy because it involves money. We have 3 funding mechanisms. Okay, one is the Single Resolution Fund. This is a fund which has been set up to finance resolution. So if money is needed in resolution, this fund is a collective fund from the banks. So it's basically financed by contributions from the banking system in the banking union, and it is available. When it reaches full capacity, it will be about between 55 and 70 billion. It is, I think it will be 8 years, so we're now 3 years in. But it will reach probably between 55 and 70 when it's at full tilt. And it will be used if money is needed to finance resolution. So again, it's another sort of bulwark between the taxpayer and the need to finance resolution. EDIS is the pillar on deposit insurance that we would like to have, and I'll come back to that in a minute. This is the European Deposit Insurance Fund. So this is to basically have a single deposit insurance fund for the banking union, which is not the case today. And then this BSTP is just short for backstop because I couldn't fit it in the chart. And this backstop is a fiscal backstop which stands behind these other 2 funding mechanisms and basically says that as a last resort, so after you've bailed in and after you've used the SRF, if you still need financing, then this is available. But it is not a tool of mutualization. It is not a tool of common fiscal policy. This is a backstop. It's called a backstop for a reason. It's a last resort. But it's important to have it there, and I'll come back to this later, because every other resolution framework that works in the world has this backstop. They very rarely use it. But what it's there for is to give credibility to the framework, so that the people in the framework know that whatever they say they do, they can do. And the people who are affected by the framework, investors, banks know that whatever the resolution framework says it will do, it has the capacity to do it. And that is very important when you're dealing with resolution. So, this is where we should be in the steady state. So, where are we? Well, where are we? We have the single rule books mostly. Okay. We have the CRD and CRR in place, but we're still, as Karolina will know, we spend a lot of our time updating these things, and we're still building the capital requirements regulation along the Basel reform process. So there's work going on in Basel, in Switzerland, part of the BIS, which is to complete the global reform for banking regulation in terms of capital. And we are currently putting through what I would say is the second last revision of this. There's one more to come, and then it will be in place. But it is largely in place now. We have the resolution, the Recovery and Resolution Directive in place. That's been there since 2000. All of these have been here since 2014. This we will have to review at some point, but it is largely again in place. And we have the Deposit Guarantee Scheme Directive, which has been in place even earlier in 2014, but was updated in 2014. So essentially we have the rules in place. We always have to work on rules have to change, but the basis is there. The supervisory mechanism is also in place. It's been there since 2014. There's now between 1,500 and 2,000. I'm never quite sure how many people are in Frankfurt, but between 1,500 and 2,000 who are working in this now central supervisor. It's a sort of mixed system where you have a central supervisor, but they use the national supervisors quite a lot. So it's not that national supervisors disappear from the picture completely, but the policy making is centralized now. Operationally, you still have decentralized functions, but the policy is centralized. The single resolution mechanism has been operational since January 2016. Has been getting quite busy lately, so it has been handling or deciding not to handle about 5 banks in the last year. I sit on the board of this as an observer, so I know exactly what's going on. These are the sort of late nights you spend, early mornings, deciding whether to resolve a bank or not. This is also up and running. And the Single Resolution Fund was also operational in 2016, and this will be accumulated towards its peak of 55 or 70 billion, as I said, over 8 years. So we're about roughly 3 years into that now. So I think we have a lot of it in place, and although I'm biased, and of course I'm biased, we think it's working pretty well for a body, an arrangement which has just been put in place 3 years ago. Of course it has wrinkles, of course it's not working perfectly, but the FDIC in the United States, which is the equivalent of our resolution board, has 75 years of experience. It runs like a Rolls Royce. I guess when we get to 75 years, ours will also run like a Rolls Royce or a Mercedes Benz or whatever. But we think, on the basis of what we've seen so far, that it's working as we expected it to work. But there are, of course, some key elements missing from this. And the key elements missing are the Common Deposit Insurance Scheme, which has not yet been agreed by the Member States, and the Common Fiscal Backstop, which was agreed by the Member States, but it is agreed before 2024. So by 2024 they have to have it in place. And of course, as Karolina will also know, the Commission spends most of every meeting reminding the Member States that they need to put these two things in place. Now, why do we need to put them in place? Well, okay. We think we need to put them in place because, sorry, I go back one. Because banking union, although it's working, will not fulfill its potential unless it's complete. Because it's not going to work fully. Why is that? Well, of course, we have now what we think is centralized, consistent supervision, which is good. I spoke earlier about breaking the doom loop. The doom loop, this link between national sovereigns and national banks, is always discussed in terms of the money. How much do I have to pay, and I want to break this? But why did you have to pay? You had to pay because there was also a link at the higher level between the supervisor and the banks. One of the characteristics of the financial crisis, not just here in Europe, but throughout the world, was the amount of supervisory forbearance that was around. Banks were allowed to continue to function, in many cases to continue to pay dividends when they were losing capital. The hope was that if we just wait a bit, things will pick up and we'll get through this. This forbearance, in a sense, made things worse. And so part of the banking union is to break that link as well. So to have a more neutral supervisor who is not influenced by the fact that this particular bank is a national champion, or this particular bank employs a particular number of people, but can give a more neutral decision. That, of course, is tough. It's tough for the member state in there, but of course it provides in the end a better, a more consistent form of supervision, not necessarily for the supervisor, but for the taxpayer of the country concerned. The same is true of resolution. Resolution decisions need to be taken neutrally, taken in the centre, and not influenced by what bank it is or what bank connections, etc. This doesn't mean, however, that you ignore the macroeconomy of the country. It's just that you make a balanced, neutral decision about the bank against the public interest. Okay, against the assessment of the public interest. You don't do it in complete isolation, but it's a neutral decision based on the economics, etc. And that's important. But however, so that's good. You centralize decision making and you make decision making more neutral. But of course you're collectivizing decision making, but the consequences of decisions remain national. So you need to have the financing element that says, okay, we make decisions collectively and we essentially manage the cost of those decisions collectively as well. And that's where the financing comes in, EDIS and the Single Resolution Fund and the backstop. In terms of EDIS, the simple logic of banking union is that every depositor in banking union is equally safe. It's like in Sweden. You would not accept if depositors in the north of Sweden were less safe than depositors in Stockholm. It would not be a banking union in Sweden if that was the case. So we cannot accept that in the banking union, you have some depositors who feel less safe than others. And they feel less safe than others because their deposit guarantee scheme, which only ever covers the marginal depositor, it doesn't cover all deposits, is ultimately backed by the sovereign there. And if the national sovereign is a weak one, then that depositor feels less safe than a depositor in a country which does not have fiscal problems. So we see EDIS as a necessary way to make all depositors equally safe and then prevent runs within the banking union. And these runs don't have to happen across border. Everyone thinks, oh, well, everybody in country X will run to country Y. They just have to run across the road. They just have to move within the country to cause a problem. So we need EDIS so that everybody feels safe. And the main risk in any banking crisis is a deposit run. This is what sets it off. And so we need to put this in place to make it so that every depositor, whether he's in Spain, Portugal, Italy, Sweden, or wherever, when you join, and you will join, I hope, everybody will feel equally safe. The other reason why we need to have EDIS and the SRF in place, and the backstop in place, is that the credibility of a resolution framework has to be absolute. If you are going to resolve a fairly large bank in a financial system, and the objective of the resolution framework is to resolve a large bank which could be potentially systemic in a way that is not systemic. Okay? So this is the trick. So we can take down a fairly large bank without bringing down the system as a whole. To do that, everybody involved has to have full credibility in the resolution framework. If people start having doubts that this framework will work, they'll run. So again, and that credibility is partly a function of the decision making, so the bodies have to make good decisions, but they have to be believed. So if they say they're going to do X, and X is going to cost Y, there has to be full belief that Y is available. Okay. Now Y can be financed under the resolution framework in Europe partly by bailing in equity, partly by bailing in subordinated debt. If that doesn't work, then you can use the Single Resolution Fund, so the banking system plays, and then you need the backstop. And this again is perfectly logical in the sense that you distribute the costs of a crisis appropriately. The first in line are those stakeholders of the bank that's in trouble, because it is their bank. Next, the banking system, which has a stake in resolving this bank without a systemic crisis, makes its contribution to the resolution fund. But if that doesn't work, society also has an interest in not having a systemic crisis. So as the last resort, society makes its contribution. So this is logical. Then the last reason why I think we need to have it in place is because we need to, and this gets a bit economic-y, so I apologize if it gets a bit, but we need to align incentives within the structures. If you're going to make decisions that are collective, so I can be outvoted by Karolina and Pehr, for example, then for me to play this game, I need to feel that the cost is also going to be collective. But if they're going to make decisions that impose costs on me, I may decide not to play the game. I may decide not to tell them things, or I may decide to find another group of people who will vote with me against them. So if you want to align incentives, you need to have this lining up between the collective decision making and collective cost management. So this is a sort of economic logic that we put out there. Of course, we run into political realities. These EDIS, SRF, these financing arrangements involve a degree of mutualization, a degree of what's called risk sharing. Now, I will argue that in economic terms, the difference between something which reduces a risk and a sharing of a risk within the system is not as clean as it looks, because you can also reduce the overall risk of a system by sharing risk within the system. But politically, there's a strong dichotomy, a strong difference drawn between risk sharing and risk reduction. And those member states who do not have too many risks at the moment insist that before they share risks, they need to see those who have risks bring them down, lower them. So we have this sort of political discussion around what's called risk reduction versus risk sharing. What does risk reduction look like? Well, risk reduction looks like passing banking laws. I've just told you we have to continue to update the rule book, so they want more risk reduction in terms of the rule book. So we have to introduce the next round of Basel reforms. I won't go into too much detail here, but we have to reinforce and complete the resolution framework in terms of the financing. So we need to have inside the banks those liabilities that can be bailed in if the bank gets into trouble. We need to reduce non-performing loans. We also, by the way, need to reduce level 3 assets, something which is not often mentioned, but these are the very complex assets that lie in the balance sheet of banks and extremely difficult to value. RTSE, which I put here, is the code word for the regulatory treatment of sovereign exposures. In other words, how you handle sovereign exposures of banks. At the moment, these are classified as risk-free for regulatory purposes, so you do not require to have capital against this risk. Some member states would like this to change so that government bonds would not be treated as risk-free in regulation, but would have a capital charge. What is risk sharing? The two things I just told you. They're EDIS and the backstop. We have a roadmap which we put in place in 2016, which identified all these various measures of risk reduction and risk sharing. But the roadmap lacked kind of a couple of important things for a roadmap. One, there was no timeline. So we have a roadmap with no idea of how long it's going to take us to get there. And there was a fundamental disagreement about whether or not risk reduction and risk sharing should be sequenced. So risk sharing can only come after all risk reduction has been done, or should go in parallel. So risk sharing could take place during the process of risk reduction. And this has separated the member states. I won't suggest what lines it has separated them on, but they're roughly broken in two parts between those who want to have a lot of risk reduction up front and those who argue that you should do risk reduction and risk sharing at the same time. There is no disagreement about risk reduction. Everybody agrees that risk reduction is good. It's good for the country concerned. It's good for the system. The question is whether or not you have to wait till after the risk reduction is done before you can start the risk sharing. And as I said, our position in the Commission has been in favour of parallelism. Basically because, as I said, we don't recognise this very strong distinction between risk reduction and risk sharing, because you can reduce overall risk by sharing it. And secondly, it may not be possible for some member states to reduce all of their risks as quickly as we want them to do unless there is some mechanism for underpinning what they're doing through a risk-sharing mechanism. So in a sense, the dynamics of the process may benefit from having parallelism rather than sequencing. But politically, of course, member states in some cases have to go home and explain to their taxpayers that there's a degree of risk sharing, and they're going to have to share the deposit insurance with a country which has an NPL ratio of 55%. And politically, this is not so easy. So, where are we now? Well, we have a sort of window of opportunity in two respects. One, the economics are good. This is the best we have been since the crisis. We are growing as a union, and we're growing steadily. And secondly, the political window is there. We have a new German government. We have a new French government. Not so new now, but it was new when we started talking about this. And so there's a sense that we can make maybe some progress here. What has happened? The heads of state and government have called for progress in deepening economic and monetary union. So they want to make progress in economic and monetary union generally by June of this year. The finance ministers have looked at this request and decided that banking union is probably the best place they can make progress. The more fiscal element may take longer. So the focus will be on banking union. In anticipation of this, last October, the Commission issued a communication where we laid out our view of where banking union should go. But the most important thing we did in that communication was we took our proposal on the European Deposit Insurance Scheme, which used to be a single proposal, and we broke it into two parts. And we said we will have one part in which deposit insurance will only work as liquidity, like loans. So if Ireland gets into trouble and needs to use the common deposit insurance scheme, it will get a transfer, but it will not be permanent. It will be a loan which will be paid back. And then in the second stage, after the banks have reduced risks and after they have been assessed, we would move to the full EDIS, which would involve EDIS taking losses as well in deposits. So this is an important difference which we put forward and which seems to have unlocked the discussion around EDIS. So a lot of technical work is already underway on EDIS, on the backstop. We also have to do now work on quantifying risk reduction because the member states want to know exactly how much risk is being reduced before they agree to risk share. So this is a lot of technical work which is underway now. It started, I have to say, it started before the end of last year, but it will continue right up until June of this year. And hopefully in June we will have a basis for allowing at least the political level to make a decision. I'm not suggesting that decision will be easy, I'm not suggesting the decision will be quick, but I'm hoping that we will get decisions on the roadmap, so to make the roadmap more operational, so timelines, sequences, what goes with what, how we can get risk sharing, how much risk reduction we have to offer. And that will come in June 2018. And that will lay out then a path to the completion of the banking union by a given deadline. And at that point then banking union will be in its completed form. So that's where we are. And now I'm wondering where you are. I heard yesterday your Nordea moved to Finland, which is good news for Finland and not such good news for Finland. It depends how you see that. So Sweden, of course, is not part of the monetary union. And I think the benefits of banking union are, I will be honest, as I said, I'm not going to make some aggressive sales pitch to you. I'm going to be honest with you. Banking union makes an awful lot of sense if you're part of the monetary union. If you're sharing a single currency with a single monetary policy, you don't have exchange rate flexibility, and you want to have a cross-border banking system, then banking union makes an awful lot of sense. And that is why it was automatic. I mean, there was no discussion in the end. That doesn't mean, however, that if you're not part of the monetary union, banking union has nothing to offer. And that's why we left open the possibility for non-euro members to be part of the banking union. Because, at least in my world, the DG FISMA world, we have always presented banking union as a single market operation, not as an EMU. And why is that? Well, it's because we're trying to create an EU financial space. We're trying to create an integrated banking model for the union as a whole, and not just for the monetary union. So it still makes sense for a country that wishes to be part of an integrated financial system to be part of that system which is most integrated. So I think, to the extent that Sweden wants to be part of a financially integrated space, it does make sense to be part of the banking union. So banking union offers this prospect of more integration. Of course, it offers this on the basis of a centralized architecture. And here Sweden will face the same trade-offs that well, every member state that joins any framework of integration, any framework of pooled sovereignty faces. You face the sort of the reverse argument, I think, that's going on in the United Kingdom at the moment. Yes, you have to centralize, you have to pool your sovereignty. So your supervisor now becomes part of a bigger supervisor. So you're no longer independent in that sense. Although, however, how independent anybody is in a globalized world is an open question now. But you're certainly less independent inside the banking union than you are out. But on the other hand, you're sitting around the table when the banking union decisions are made. And Sweden will be a relatively small financial system next door to this very large banking system. It may well be in your interest to be sitting around the table when those decisions are made, because believe me, the decisions that will be taken inside the banking union are going to affect Sweden, whether you're around the table or not. So again, you have to face the question that anybody engaged in pooled sovereignty is, what is the trade-off? You lose some independence, but for that you get influence around the table. And again, from my observation of these bodies, it is not that the centre rules. These are bodies truly of pooled sovereignty. There's a board. This board functions as a board. Everybody is heard. Everybody speaks. So it's important to be around the table. And if you wonder about voting rights, let me tell you, as a member of almost every board as an observer, the Commission is observer in almost everything. We don't need to vote. The important thing is not to vote. The important thing is to be there and speak, to be heard, and therefore influence the vote. So being part of the centralized architecture will give you participation in banking union policy making, so your voice will be heard. In return, you will be able to get, I think, consistent supervision across the system. Every supervisor I talk to tells me, oh, I think, before the crisis, every supervisor would tell you his method was the best. We should all harmonize, but harmonize on my arrangements. In the end, nobody's national supervision proved particularly fantastic. And what's going on in the banking union is trying to take the best practices from all and meld it into one, overall better system. So I think there is an enhanced quality of supervision coming out of the SSM. And then, of course, you'll be part of this credible resolution framework with the backing in steady state of this common deposit insurance scheme and the resolution fund. And it's just a basic law of numbers. The bigger the pooling arrangement you're involved in insurance, the better cover you have for each of your individual banks. So it just makes sense, and we have presented papers to the member states to show them that being part of this pooled common deposit insurance scheme is just better than having one of your own. And we have simulated using econometric techniques. We have simulated hundreds of shocks to show that, and it shows in every case, you're better being part of the big pool than in the small pool when these shocks hit you. So that's my sales pitch. You can see where we are, where we're going, why we think you should come along. We think banking union is necessary for deepening EMU, for making EMU more resilient to shocks. I think the crisis revealed that we were not ready, so we had to do some work. Some of the fragilities we found are being addressed now by banking union. As I said, we have it, I would say, 65% in place, but we need the other 35% quickly. The final pillar for us will be get EDIS and backstop in place. It is controversial. You will read a lot about this. The member states are fighting over it. But this is not unusual. And it's almost a healthy thing, in my opinion, because it makes sure we get a balanced solution in the end. But we do need to make progress. We cannot just keep arguing all the time. Some member states, as I said, want risk reduction as a condition for risk sharing. This is a logical request, but again, I would not exaggerate this difference between risk reduction and risk sharing, and I think a parallel approach where we reduce risk and share risk at the same time is possible. We have this new political impetus which is coming now. We have a window of 6 months, 3 of which are now gone, till June. I think in June there will be difficult choices for ministers, but the heads of state want them to take it, so they will have to make these choices and present something to the heads of state. We believe that if they make the right choices, banking union at its full potential will bring a lot of benefits to the monetary union. It's kind of truly pooled risk management for banking in Europe. I'm not suggesting that Sweden cannot survive if it stays outside, but I think it'd be much better if you were in. Thank you very much.
Should I just... I have a presentation. Or? Oh, there. Well, thank you very much, and for having invited me to talk about these issues, and thank you very much to Sean for making a very clear presentation of what the banking union is about, where it is now, and what the prospects are. I appreciate that you're not doing a sales pitch, but I think in reality you are doing a sales pitch, because I think people think that if everyone involved in this construction is such a sensible person as you appear to be, then we should definitely join. But having said that, I will say a few things about the banking union from the Swedish government's perspective, and maybe also from the perspective of a member state that is involved in discussions about how to proceed. And as you got from Jean, these discussions are not always terribly amicable. So let me start by reiterating some of the things that Jean was saying. Now, why is the banking union important? I mean, more generally. Well, I think there are two reasons, and they are somewhat interlinked, and I think they are reasons that Sean was talking about. So one reason why it's important is because it's a reform that potentially could make the monetary union more robust to having problems in the financial systems of individual member states. So it's something that was revealed during the Euro crisis, that problems in one country seem to create risks for spilling over to other countries, and ultimately perhaps even to bring down the whole monetary union itself. And that's related to this doom loop between weak banking systems and weak public finances that Sean was mentioning, that created very bad dynamics. So that's one reason that has to do with the monetary union and with the stability of the monetary union. But then there is this other issue that Sean also talked about that's more related to the single market. And I sort of phrased it in the sense that if you have integrated markets, which you do have when it comes to banking, but regulation and decision making is really decentralized and carried out at the national level, this doesn't really work very well, at least not all of the time. It tends to create problems. Maybe it created more problems in connection with the global financial crisis than in normal times, so it's somewhat linked in with the first reason here. But it's still something slightly different. It's more linked to single market than to monetary union. So, why is the banking union then important for Sweden? Well, I think on both these accounts you can see a reason why the banking union is important. Regarding the first, we have a very strong interest of a robust monetary union, and that's completely independent of whether we are part of the monetary union or not. And that's simply because the Eurozone is such an important economic area for the outlook of the Swedish economy. So if the Eurozone is doing poorly, we are also likely to do fairly poorly. So that's related to this first aspect. But then, of course, there's this second aspect, and the Swedish financial sector, which even after the move of Nordea's headquarters is going to be significant, it's closely integrated with the rest of the EU. And then we do have this issue that maybe national regulation and decision-making creates problems. So, where are we now? Well, Sean described the discussions regarding risk reduction versus risk sharing. I noted that his own title was risk reduction and risk sharing. So that's obviously sort of the perspective of the Commission and also several member states. But as Sean explained, there's also a group of member states that are quite adamant that you have to be very sure that risks in national financial systems have been reduced sufficiently before you're ready to go ahead and discussing these risk-sharing mechanisms that still haven't been put into place in the banking union. So that's the backstop that Sean was talking about, and in particular for the Single Resolution Fund. And then, of course, EDIS that, well, still isn't really there, but when it's there, it also needs a backstop. What's going to be done regarding this in this process, leading to some kind of decision in June? Well, I think for those countries that really want to be sure that risks have been reduced sufficiently in order to go further, I mean, there are some straightforward indicators that you would want to follow, and I think Sean will probably be involved in presenting those. So those would be measures of non-performing loans in the national banking systems and how much capital and liquidity the banks have. And then there are these slightly more controversial aspects of this that some member states are asking for, but maybe also other member states don't really want to have as a part of the sort of the package that tracks risk reductions. So one is indicators of sovereign exposures. Sean explained that regulatory treatment of sovereign exposures is something that some member states are completely against. But of course, for some member states, it is important to be somewhat informed of how much national banking systems are exposed to their own sovereign's debts. So I brought this diagram from EBA that shows banks' net positions to domestic sovereigns as a percent of their total net positions to sovereigns. But this information is actually quite outdated. But I guess it's something like this, some information like this that some member states would like to sort of follow in time. But you can also note that if you do look at it like this, it's not, I mean, you have fairly high shares even in countries such as sort of Germany, and we ourselves also have relatively high exposures to our own sovereign debt. So it's not all about countries such as Greece and Portugal and Cyprus or whatnot. Another indicator I think that some member states would want to look at is the progress regarding build-up of bail-in buffers. So Sean was also alluding to this framework being put into place, the resolution framework. Part of that is to also require banks to have bail-inable liabilities, so that you can resolve a bank in an orderly fashion and allocate losses in a reasonable way, protecting taxpayers. But of course, this is something that is under is sort of in progress, and we don't know exactly how much buffers there are in various national banking systems at this point. So these are probably type of indicators that are going to be discussed in the coming months. At least that's my expectation. So let me say a few things about why the government decided to actually put in place an inquiry into pros and cons of banking union membership last year. So why would we want to study this now? Sean did actually mention some of the reasons. One is that some important elements of a banking union have now been in place for some time. So the single supervisory mechanism, for instance, has been up and running for some time. The European stability mechanism, the sort of the crisis mechanism that has been in place for some time. The single resolution mechanism is in a build-up phase. I mean, the resolution fund isn't really completely there yet, but there is a framework for this. So that makes it more interesting to look at, given what we know of how these elements work, what would be the pros and cons. Then there are, of course, some other reasons. The exit of the United Kingdom from the European Union means that the part of the financial sector in EU that is outside the banking union becomes much smaller. Because, of course, since in the UK we have the biggest financial center in all of Europe, when that center leaves the European Union, that leaves a much smaller part outside the banking union. Our neighbor, Denmark, has decided to look into this issue and has declared that they are going to take a final decision in the fall of next year. So that's also something that we have to reflect upon and see what it means for us. And then we have Nordea, of course. So the decision by Nordea first to branchify its structure and then to move its headquarters to Helsinki, and also with explicit reference to the wish to be inside the banking union. That's also something that you need to think about what it means. So therefore, we have this study up and running now, and it's going to hopefully come with its conclusion sometime next year. Let me end by saying something about an initiative that is related to this, and that is a non-paper on the future of the monetary union, that the Swedish Minister of Finance signed together with the Ministers of Finance from 7 other EU member states. And you see the flags on this picture, so you can note that it is to a large extent a Nordic-Baltic initiative, but it also includes the Netherlands and Ireland, Sean's home country. So I guess one way of looking at this group of countries is that it's a very large part of Northern Europe. And I guess it's no secret that in these discussions there's a very clear geographical divide. It's very different views in the north vis-à-vis the south, that the geographical dimension seem to be much more important than any ideological dimension. But this non-paper does touch upon the banking union, so I thought I would just briefly tell you the main points of this non-paper. It didn't receive a lot of attention here in Sweden, actually. It did. I think my feeling is that it received more attention outside Sweden. But what's being said in this paper is that discussions about issues that have relevance for all EU member states should take place in a format where all EU member states are around the table. And that includes most aspects of the banking union. It's also stated that what's really important in order to strengthen the monetary union as a construction is policies pursued at the national level that regards both things that has to do with risk reduction, but also fiscal policy and prudent fiscal policy, and compliance with the rules that member states have decided on jointly is important. A third point is that in sort of developing and strengthening the monetary union, focus should be on initiatives with strong public support and on initiatives that are crucial for a well-functioning monetary union, rather than initiatives that aren't so critical for having a stable union, but are things that maybe some member states think it's nice to have. So crucial for delivering stability and delivering increased growth potential. Fourth point is that having said this, a priority should be on completing the banking union. So I think there's, as Sean also indicated, there's actually strong agreement among all member states. There's also a point about a willingness to develop the European stability mechanism. Not so important for us because we're not really part of it at this point. But since it is being discussed that the ESM is likely to be the source of a backstop for the resolution fund, and eventually maybe for EDIS, it has potential implications for us. And lastly, there is also a point about trying to structure things so that you would support implementation of structural reforms at the national level, but of course respecting also national responsibility for such policies. So this is a list of positions that these countries stand behind. I think in the media it has been portrayed as a quite sort of a counterpoint to the French position, which is much more ambitious maybe in terms of what the French wants to do with the monetary union. And I guess right now the crucial question that everyone wants to have an answer to is where the Germans are going to end up in this. Thank you.
microphone, please. Okay, we have a little bit less time than I thought, but it was well spent time to go through this carefully. And maybe we will need more seminars like this in the future. Since we have only 15 minutes, and to avoid the risk that we have one question that we spend 15 minutes on, I thought maybe if we could have 3 or 4 questions, and then you can take them as you time allows. Please, and wait for the microphone. And give me ask your name, please.
Yes, Pehr from the National Debt Office, the Bank Resolution Authority here in Sweden. You had many questions which I came this morning, Mr. Berrigan, but you've been addressing a lot of them already. But one thing which I think is a bit outstanding is this window of opportunity you are referring to. And the question is, I mean, how open it really is, because it is obvious that a number of member states now are not that keen on those risk-sharing elements which you are referring to, Holland being one example. Austria, I would argue, probably one. Italy, no one's not going to happen. And also Germany, a coalition which includes Jens Spahn but excludes Martin Schulz. How keen will they be on these elements, independent of what is in the coalition treaty? So, in a situation where you don't have these progress which you're referring to, what kind of scenario would you see playing out without those risk-sharing elements going forward? Thank you.
Okay, how open is the window of opportunity? Yes.
Thank you very much. Kristin Magnusson Bernard from Nordea Bank. I should stress that these are my questions and not those of my employer. My first question follows a little bit on Pehr's. Imagine that we don't have this progress in June and we have implemented bank resolution, but we don't have bail-inable liabilities in place. Have we not in fact increased the risk for the depositor in the monetary union, or sorry, the banking union? My second question refers to, you opened your talk, Sean, with saying that, you know, the monetary union was not prepared for a crisis. You could also say that maybe we had everything we needed. We had the no bailout clause in the treaties. You sometimes hear the argument that this, had it not been for political concerns and contagion fears, would have been all we needed. So why is this new set of rules better than the old set of rules?
Okay. How many can you take in 10 minutes?
Martin Blåberg, Handelsbanken. So I have a question regarding what I would call the risk aversion when it comes to financial crisis. My impression is that in Sweden, after the financial crisis, there's really been a raising of a lot of requirements on banks, higher capital requirements, higher requirements on subordinated liabilities for bail-in, resolution fees, etc., etc. I don't really think that that's the reason for that is that the Swedish authorities think that Swedish banks are more risky than other banks. It's perhaps, it has been talked a lot about the size of the banking system. Perhaps that's a little bit less of an argument when Nordea is moving, but my impression is still that probably the Swedish authorities have a bigger risk aversion against a financial crisis than other countries. And that is sort of the main reason why we have the higher requirements here. So my question to Sean is really, is it possible within the banking union for one country to have a higher risk aversion and higher requirements, even if you're part of the union? And maybe perhaps also is there a reason for it? And to Karolina, is this an argument for Sweden not to join the banking union, or should it be possible to have sort of the same risk aversion as other countries? And I take it from your comments on risk reduction that you feel that it's important that perhaps the weakest countries are moving forward in terms of risk reduction, but perhaps to sort of a more general European level than the much higher Swedish level, if you see what I mean. Thank you.
Okay. Any more? Could I maybe just add one, Nordea? If sort of a couple of years from now, Nordea should run into some sort of difficulties, this is not a forecast, but hypothetically, and it's a very important large bank in Sweden. So what would be the difference in the resolution work if we are a member of the banking union and if we are not? Are there pros and cons, and what might these pros and cons be in such a situation? Okay. Yeah, so please, Sean, would you like to start?
Okay, thank you, and thank you for the questions. The window of opportunity. Well, we've had so few windows of opportunity recently. We want to grab them when we get them. And I think what's important, I mean, I live in what's called the Brussels bubble, where certain things are important which don't seem important to other people. What is important here is that the heads of state, who are not necessarily focused on the financial side, but the heads of state have asked that progress be made here. So a political commitment has been made to make progress. Now, of course, what degree of progress is made remains to be seen. But that, in my world, is important, because the finance ministers work for the heads of state. So when they're asked to present something, they need to present something. We have, from the Commission side, we think made, and I think there's nobody questioning the economic case we make for completing the banking union. I mean, I make this statement all the time. We discovered in the crisis that EMU was not finished. So part of finishing banking union, part of finishing EMU is to have banking union. We should not now half finish the banking union. Okay, we cannot keep half finishing things. So there is a sense, I think, a political sense as much as economics, that we have to sort of finish this banking union. It is a tricky question, but I think we're not asking people to deliver on the spot in June. What we're asking, and what the heads of state are asking from the ministers, is to come up with a credible roadmap, a credible plan, action plan, to get you to completed banking union. So it may seem that we're asking a lot, but in fact, all you're asking people to do is to say how you're going to get there. It's not that in June you decide to go there. So I think we do have the right political alignment. There has been an issue not so much of alignment, but just of people not being around the table. Germany has had to negotiate its coalition for 5 months. This has been an issue where, you know, the current German minister has been a caretaker, so he's not been in a position to make his position clear, as Karolina has said. So we wait to see what that position will be. But, you know, we believe we will make progress here. Do you want me to go through them?
No, we can. No? Maybe okay. If Karolina wants to comment on the window of opportunity.
No, I mean, it is, as Sean says, I mean, that's something is required to be delivered in June, but then what that is, we don't really know. And, I mean, these 3 months since the Commission came with its package in December, Germany hasn't really had a sort of proper representation at the table, so we just have to see. Personally, I'm a little bit, I mean, I don't like the phrase window of opportunity so much. I mean, it sort of indicates that now we have the chance to push through things that people don't really want. And I think there's a little bit sort of a sense of that. But everyone is working on a particular timeline, the Commission on its timeline, because there's going to be elections to the European Parliament next year. I think it's important also for the Commission to be able to deliver something before they have to reform themselves or restructure themselves.
Okay.
I mean, just to go back on the window of opportunity, which I'll now feed into the second question. I mean, the reason we refer to window of opportunity is not that we want to, you know, require countries to do things they don't want. What we want to explain is that if banking union is not completed, and the next crisis comes, we'll not be as ready as we should be. So the window of opportunity is not that we're saying we have these 3 months, let's do it. It's that, you know, we don't have forever to do this. And there is a sense, I think, among some member states that we can do this over the next 20 years if we want. If we have another crisis, anything like what we've had in the past, and let's hope we don't, but it doesn't have to be as bad as it was in the past, the banking union will not be ready, just like the monetary union was not ready. So, you know, our argument to the member states is, you know, now, you know, we have come out of the crisis. We are through the acute phase of the crisis. We're not out of the crisis, but the acute phase is past. You have growth in the economy. You have a situation where you can take your breath, because I have to tell you, for the last 8-9 years, there's not been much time to relax, because we've been constantly addressing one crisis after another. Is take your opportunity now to do this. We're not saying it's politically easy, but if you don't do it, it will be a problem down the line. And this brings me to your point, if we don't do it. Again, I don't want to exaggerate here. We have a part of the banking union which is functioning and is functioning reasonably well. The bail-inable phase, I think, is in a sense detached from this. The build-up of bail-inable material in banks is driven by, in a sense, a process that is almost global. So it was agreed in the G20, and we and the Commission will put forward and have put forward legislation on that. It's a part of the banking package, as we call it, the risk reduction package, which we will deliver in any case. Okay. This is our whole point in this discussion. We have committed to deliver this. That legislation will be in place, and once the legislation is in place, it'll be up to the supervisor and the resolution authority to make sure that that material is built up. So I think this is a process which is almost independent of the other roadmap. This is going to happen, so I'm not so worried about there. And we have central authorities which will decide how much the bank needs to hold, and we have authorities that will check to ensure that the bank has it. The issue there is about timing and phasing. A lot of this material, not so much here in Sweden where, Nordea now, here in the Nordics, let's say, where the banks have held a lot of capital anyway. But in other parts of the world, there's a need to build up this subordinated debt. Europe does not have a huge market for subordinated debt. We've never had one. The US much more developed than we are. So there's an issue of phasing here. We have to give it an amount of time, otherwise the cost of this will be astronomically high. But I don't have any doubts that the banks will build it, and that we will be in a position, when the authorities say they need to have it done, it will be done. And this, I think, is a process that is a bit independent of the roadmap I'm talking about here.
Karolina?
Well, maybe I move to the question about sort of Swedish authorities maybe being more risk averse than supervisory authorities in other in the banking union. I think our position has always been that it's important to have some sort of flexibility to adjust requirements on the financial institutions to sort of national circumstances. And of course, even with Nordea's headquarters in Helsinki, we are going to have a largely or a fairly large banking sector vis-à-vis the size of the Swedish economy. And I think that is ultimately what has been driving policymakers and the supervisory authority to be quite strict on banking requirements. My feeling during the years that I've been part of negotiations, sort of international negotiations about bank requirements, is that we've always had to struggle, or in the European Union, we've always had to struggle in order to be allowed to have stricter requirements. It's always felt like a tendency for trying to put sort of ceilings on how high you can go. And we have always argued that in this area what you want to avoid is a race to the bottom. You don't have to worry about races to the top. If you had to worry about that, you would see banks with loads of capital, very well capitalized by themselves, and having heaps of liquidity buffers and so forth, and that's not what you see. So that's important for us, and how that's going to play out in this discussion, I mean, that's for our inquiry to consider.
John?
I'll come back to what Karolina says in a minute. I didn't answer your question about Article 125. Article 125, for those in the audience who don't read a treaty every night before they go to bed, is a treaty which prohibits the transfers of budgetary transfers between member states. Okay. The fact it did work. The problem was not that it didn't work. The problem is that it did work, and that the banking system had assumed it wouldn't. I mean, I remember having long conversations with bankers before the crisis where they'd say, "Oh yeah, Article 125, that's great, but that's not going to happen." In reality, if we have a problem and European banks are in trouble across borders, everybody will group together and bail us out. Well, it didn't happen that way. There was Article 125 held, and the member states did not bail each other out. And that is in fact why the banks refragmented, went back home to look to be covered by their national sovereigns, but some of these banks had become very large. If you take a bank, you take a bank like Nordea and put it against Swedish GDP, and take a bank like Nordea and put it against EU GDP, Nordea looks like JP Morgan against EU GDP. It does not look like JP Morgan against Swedish GDP, or now Finnish GDP. So this then brings me to the second point. And this or ING in the Netherlands, these monster banks, or my own country had 3 banks, 3 of them 100% of GDP or more. This becomes a problem when the tax base, and if you're relying on bailout and your tax base is small, you have a problem. It might have been less, as these banks thought they were covered by the European tax base, then it was okay, but that wasn't the case. Article 125 worked, and the tax base was not available. In terms of people being risk averse, of course, different member states have different views of the banking system. Different member states, of course, have different size of banking systems in terms of GDP. And this can also lead to differences in risk appreciation. For us in the Commission, it's always a tension between what we call gold plating, i.e. going beyond the minimum that we set, and the single market. Now, you can argue that the fact that Sweden has higher capital requirements than Italy, is this an issue for the single market? Well, if you talk to the banks, it is. The banks prefer, if they're going to go across border, to face a single regulatory regime. It's easier for them to work, it's easier for them to organize. But that then brings you into this tension between the single market and the national requirements. The solution to that, of course, is to do what we're doing, which is to centralize, so that a country like Sweden would become part of the banking union. The supervisor would be in the center. The supervisor then would assess the bank against not its national GDP, but against the banking union GDP, against the banking union requirements. But the supervisor is not powerless in the SSM. It can, in what are called Pillar 2 requirements, it can take a bank-specific view. So if it thinks a bank is particularly risky, it can increase capital. So it has a single kind of base rule book, but it does retain the right on a bank-specific basis to give different capital requirements, to give different regulatory requirements based on the risk profile of the bank. So don't believe that if you join the banking union and you come in with a risky bank, that your bank is going to get an easy pass, because it won't. If your bank is risky and you come into the banking union, it will be regulated as a risky bank, because the banking union retains the right to have Pillar 2 or bank-specific treatment. So I think this issue of tension between national aversion to risk and the average is in some ways eased when you move into a banking union framework, because you have this centralized single framework that allows you to kind of manage that tension, I think, in a more efficient way.
Okay, we are out of time, but we started 5 minutes late, and we've left this question of if Nordea should run into difficulties, and it's a big, important bank in Sweden. What are the pros and cons for Sweden of joining the banking union or staying outside of it when it comes to rescuing such a bank? In 5 minutes.
I mean, it's not so easy. I mean, it's something that, again, the inquiry is probably going to spend some time thinking about this. But of course, as Sean was saying now, one on the positive side, if there are significant costs associated with having to deal with a failing Nordea or problems in the Nordea, those costs could very well be mutualized within the banking union, and that is of course an advantage compared to if all the costs have to be taken by Sweden or sort of Swedish taxpayers. So that would be a pro. I mean, then you can have ideas about how supervision and decision making regarding resolution and so forth would be carried out in the two different scenarios, but I think it's very difficult to say that there would be obvious differences there.
Okay. But we will have a government investigation trying to answer those questions. Chance, you have the last word.
I will not go much beyond that. I mean, I think the issue now is that Sweden has become, since yesterday, a host country when it used to be a home authority. You will be a host country within the banking union and without the banking union. Inside the banking union, of course, you will also sit on the board of the supervisor and the board of the resolution authority. So you will have more say in how the general policy for banks are set, and your voice will be there. Outside, in a sense, you will be a rule taker. This does not mean you will be ignored, because it's not the case. I mean, the host country is still consulted by the SRB, because the SRB, in a sense, or the SSM, they're just another supervisor in the European Union. They're now a very big supervisor, but they're still another supervisor, so they still consult with everybody else. So as Karolina said, I mean, first of all, one doesn't want to think about these kind of things because it's not particularly nice. They don't sleep that well. But if it was to happen, it's hard at this stage to say there's going to be a huge difference. The big difference, as Karolina says, is that you're part of the mutualization framework, so there'll be more support, more collective support. But I think also the other difference is that you will be around the table when the general policy for this bank is being made. And so you'll be on an equal footing, a fully equal footing with your home authority, which is now Finland.
Okay, thank you very much. We have run out of time. I don't think we have run out of questions, so I hope we can have you back here to answer those other questions as well. Thank you very much.